Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's September the 15th, 2016. I trust all of our clients and friends had a wonderful summer, which I hope included a little bit of time off. Well, we're back in the swing of things in the fall here, and in fact, the markets have been quite active, both up and down throughout the month, creating a lot of volatility. Now, one of the reasons for that volatility has to do with the direction of interest rates. Will interest rates start to go back up again? Now, next week, the Federal Reserve is going to be meeting. This is the central bank for the United States. And on the 21st, we will hear what their next pronouncement is. And the tension in the marketplace really surrounds, unfortunately, it really shouldn't, but it does. What the central bank is going to do is if the whole world economy hangs on what these characters are up to. But that's really where we've gotten to in terms of our current situation, because there's been so much manipulation on the part of the world's central banks in pulling down interest rates and printing so much money that the markets continue to just wait for what the Federal Reserve is going to do next. So, in our view, we don't know what the Federal Reserve is going to do next week, but we can certainly be sure of this: interest rates are not going to move up very much. And so, if they do twig them up, 25 basis points next week, we'll be a little bit surprised. I suggest that they'll probably wait to the end of the year before they put rates up. But we're not investing around what the Federal Reserve is going to do in terms of interest rates. In our view, if the Federal Reserve starts to put interest rates up very much, it's going to cause a lot of problems in the global markets, and we want to be positioned for that. And if they don't put interest rates up, then these easy monetary conditions are going to continue to create problems in the global capital markets in terms of putting prices up too high of capital assets, feeding more bubbles, and so on. So from our perch, there really is no way out of the situation that we're in without a little bit of pain. And so that's what we're focused on. How do we minimize the pain? How do we position ourselves for what the Federal Reserve might or might not do, and get back to the fundamentals of real businesses in the real economy? So with all of this hype, my caution to you is, look, we're positioning for the next 5 to 10 years. We're not positioning for the next 5 to 10 minutes, and we're not predicating any of our investment decisions or investment thesis on the next couple of interest rate moves or non-moves, if you will. So what does that mean in terms of the various assets that we're investing and our asset allocation, along with the various types of businesses that we're investing in? Well, first of all, it means in terms of asset allocation, we're trying to keep some cash around. We're not investing all of the money. You know that if you're looking at your accounts. We're being very careful. We're keeping some powder dry. We're not all in, if you will. And so if the markets go down quite a bit, then this will be a wonderful thing for our clients. We'll be able to redeploy capital at much lower prices. So first of all, we want to keep some powder dry. And that means across all of our clients, and this is going to vary by client, we're probably about 30 to 35% near cash or short-term bonds and investments that can be sold very quickly and are not volatile at all. So that's number one. Number two, in terms of the bonds that we're purchasing, and many of you will see different bonds in your investment account, please note that we're only investing in the highest quality bonds. That means the bonds of companies or governments, but in the case of companies that are backed by great balance sheets. We're also only investing in very short-term bonds. So our bonds really only go out maybe a year to 3 years. And so with interest rate changes, there will be very little impact on the price of the bonds. And so we're keeping things very, very conservative. So that's important for you to know, and we'll continue to do that. So as our bonds come due, if interest rates start to move up, then we'll be able to redeploy those proceeds at higher interest rates. But again, I caution you, if interest rates go up very much, we're going to be seeing a real problem in the global economy, and so we don't expect that anytime soon. In terms of equities, as you know, we're very careful in terms of the equities that we're investing, and that's where 65% of our portfolio is currently invested. So the kinds of businesses that we're investing in, we take very seriously, both the quality of the companies, the balance sheets of the companies, and the valuation and growth prospects of those companies. Currently, we have about 12% of our portfolio in infrastructure, about 10% in precious metals, about 8% in financials, another 6% in real estate, also 6% in technology and water businesses, and about 5 to 6% in the consumer and also in the agricultural industries. And so you can see that we've got good diversification across fantastic sectors. And so we're very pleased with the kind of businesses that we own. Now, another point I just wanted to make in terms of currency exposure. A lot of clients are concerned about the Canadian dollar and where it's going to go, and we share those sentiments, although we're not that enthusiastic about a lot of currencies around the world. But I think it's important to point out that when we're buying our equities, the vast preponderance of our equities, virtually all of them with the exception of 3, are global businesses, and they do most of their business in the United States, along with, of course, Canada and other first country nations, or very strong economies around the world, be Europe, Japan, and of course the Far East. And so most of our currency exposure is actually US dollar. And so when our dollar drops, you'll actually note our portfolios tend to go up. And that's because of our currency exposure. The majority of it's actually in the US dollars. And this is, of course, particularly the case when it comes to equities. We're buying equities that in businesses that do business all around the world. So that's important. The next point I just want to make in terms of interest rates is if we do see interest rates go up, typically stocks that pay high dividends will come down a little bit. And so we have a number of companies that pay high dividends, especially in the infrastructure space or in the utility space. And so we just caution our investors that if interest rates were to back up, then these investments would come off somewhat, and that's because as interest rates go up, they'll compete for the dividend. And so the company that's paying the dividend, that discrepancy between interest rates and the dividend yield won't be as large, and so typically the price of the business will come down and the dividend yield will go up. And it's just really the pricing mechanism of the future value of cash flows. Now, I caution people not to worry if that occurs. We've seen this before, because the kind of businesses we're buying are growing, their dividends are growing, the capital value of those companies are growing, and any short-term moves in the stock price will not derail the long-term prospects of those companies. So I just caution you about looking just in short-term moves and being preoccupied with that, and not the quality of the business and the consistency of the dividend that is paid generally on a quarterly basis. So those are a couple of the points that I just wanted to point out to our investors. We are well positioned. We've had a very good year. We're continuing to plod along quite nicely. I'm very pleased with the progress of the companies. We are not going to chase companies and chase valuations in the market. We're going to remain disciplined and very focused. We just again just want to remind you that the issues that we've talked about over the last number of years, from debt to unfunded liabilities to the low interest rates and all of the money printing, mean that we need to be careful. These are unprecedented times in terms of monetary easing and the flexibility that the central banks have placed upon the global market in terms of just all of the different things that they've been doing, and we want to be very, very cautious. So we continue to focus again on conservative, well-capitalized businesses. I trust that update's been helpful. If you have any questions, please call, email, or stop by the office. Thank you very much. Bye now.